Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, THEKOUK.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning, Sean. I think I'm just recovering from what was an extraordinary week for the economy last week.
Well, look, before we get into that, what was more extraordinary was the debate that you had with Chris Joy on Fear and Greed about what's going to happen in the housing market, the Reserve Bank and the economy. Did you enjoy it?
I thoroughly enjoyed it. It was a good half an hour. In fact, funnily enough, Sean, I don't know quite how you're up for this, but a lot of the feedback was we wish it went longer.
Is that right?
Yeah, people wanted to sort of explore some of the details and issues there. Now, that might just be a narrow number of people, but hey, people loved it from what I can gather. And I did too.
If anyone wants to listen to it, it will be on your playlist. And the Fear and Greed, it was the housing debate. It came out on Wednesday last week, and it was a debate between Stephen and Chris Joy. Now, let's talk about last week quickly. It was pretty big in terms of the June quarter inflation, though that number wasn't quite as high as some had expected.
Yes, it was one of those ones where a bad number, because it wasn't even worse, was actually seen to be good. So, yeah, annual inflation, 6.1%, so equal to its highest level in 20 years when the GST was introduced all those years ago. The trimmed mean, which is sort of the underlying measure, was 4.9%, so a very high result. But the curious thing was, because it wasn't as high as expected, the markets scaled back a little bit their expectations for the number of rate hikes that the RBA will have to deliver over the course of the next 6 to 9 months. So, look, we've still got an inflation problem. It's still very high. It'll get higher before it gets lower, hopefully in 2023. But, there is a little bit of light at the end of the tunnel on the inflation outlook, even though, this one was a slightly better than expected result.
And Jim Chalmers, the Federal Treasurer, was talking last week too. He gave us an update on the economic projections of the government. What did they tell us?
Yeah, look, they were a really interesting set of numbers. He painted them, I think, politically rather than economically as grim news. We've got tough conditions ahead. And I think the focus, quite rightly for the electorate, I suppose, is the cost of living and the inflation rate. So in reverse order, in a sense, what the Treasury is now forecasting, which will presumably be feeding into RBA and Treasury thinking for the next few months. GDP is slowing from 3.75% last year to 3% this current year to 2% next year, which is exactly what tight monetary policy is meant to achieve. Inflation, as a result, does get higher. It hits a peak of 7.75% at the end of this year before it drops to 3.25% next year and drops below 3% into 2024. And the good news is that the unemployment rate hangs around 3.5% for the short term. And even when the economy slows, it doesn't get above 4%. So if you were to sort of say to me that, if we could have an economy in 2024 with inflation in the target unemployment at 4%, and the full effect of the rate hiking cycle having the economy slow to a soft landing of 2% GDP growth, you'd take it.
Yeah, absolutely. Absolutely. The other news last week, which was interesting internationally, is the US Fed lifted interest rates by 75 basis points.
As expected, the Fed, who've got a much bigger inflation problem than Australia, their CPI is 9%. They did hike by 75 basis points to their cash rate band. The top end of the band's 2.5%. So 75 basis point rate hikes in a row. They're serious about hiking rates. But then again, the market liked that result. Yeah. Normally you think a 75-point hike would be pretty disconcerting, but the rhetoric from Jerome Powell, the chairperson of the Federal Reserve, was that we probably don't need to hike as aggressively in the months ahead, that there are tentative signs that inflation's topping out. Oil prices are coming off the peak. Some of the labour market indicators in the US are weakening, suggesting that the wages will start to moderate a bit in the US as well. So the market thought, okay, there might be a couple more rate hikes, but not too many more. And, the bond market rallied and stocks had a nice kick up immediately after that announcement.
So it was a pretty big week last week, Stephen, but this week I reckon matches it.
Yes, I'm afraid so. There's no rest for the wicked, as they say, but it's a corker.
Let's start with tomorrow. The Reserve Bank board meets.
Tomorrow's board meeting, look, it's a late item is there that they go 50 basis points on the back of that inflation result from last week, and even the labour force numbers from a few weeks ago, which confirmed unemployment at 3.5%. There's a bit of chatter, probably dying down in the last couple of days, that they might go 75 points, sort of use the Fed's action as a bit of cover for them to sort of get a bit more ahead of the curve. But I think at this stage, with effectively 50 points priced into the futures market, they hike 50. Their commentary on the inflation outlook, the labour market outlook, and all of the above, the things that Jim Chalmers was talking about last week, will be there for us all to read.
I mean, the Reserve Bank also comes out with its quarterly statement on monetary policy. Does the Reserve Bank and Treasury tend to agree with each other? Because they're the two main economic bodies in the economy.
Well, the interesting thing about the quarterly statement on monetary policy, in addition to the sort of detailed analysis, it's a fabulous read, is that they do put out a summary table of their macroeconomic forecasts each quarter. And we saw treasuries from Jim Chalmers last week. Now, they don't always see eye to eye, but having said that, there's rarely more than, say, a quarter of a point difference on the GDP forecast or for the inflation forecast. So if Treasury's forecasting this year's GDP growth to be 3% and the RBA said 2.75%, you would sort of say, well, that's basically the same number. It's probably just a rounding error. So they do tend to match one another. So I'd expect that statement to confirm the economy's starting to slow, that there are more rate hikes to come, and that the economy is actually doing relatively well, that we've got a little bit of momentum occurring in some of the activity indicators through to the end of the June quarter and perhaps even into the start of the September quarter.
We're going to get lots of data also this week that might just confirm what you're talking about. Let's just run through them quickly. CoreLogic house prices.
Yeah, for the month of July, they'll confirm that house prices dropped around about 1.2%, so one of the largest falls in quite a while on a month-on-month basis. Sydney leading the way. It's probably going to be down something around 2% month on month and 5% over the last 3 months. Melbourne continuing to weaken, but curiously, the smaller capital cities, Perth still going up, Adelaide's going up, and we'll have to wait and see a bit more detail from the likes of Canberra, Hobart and Darwin. But housing's definitely cooling and prices are just starting to edge a little bit lower in reaction to the rate hikes and cost of living pressures.
What about job ads? We get data on that this week too. Certainly the labour market is tight, and last week we had a few big companies, Fortescue being one, National Australia Bank boss Ross McEwen came out being another, saying, we need more immigration because we need more workers.
Yes, look, I think the job ads, which have been frankly booming in a way, with the economy just starting to cool, perhaps, that we might get a small fall, but it'll only be a small fall from an incredibly high base. But your point about what the various CEOs are saying about their ability to hire labour, that there's a real labour market problem there that you don't fix quickly. That's the first thing. The only medium-term fix, I suppose, is immigration. So perhaps in the next couple of months, we'll have a bit more of a hot debate about immigration.
And we get data on building approvals, retail sales, international trade. Fair bit this week, Stephen.
A lot of information. Building approvals will probably be weaker. We've got the sort of hangover of the ending of the housing construction stimulus during the COVID lockdowns. We know that that's probably likely. Retail sales, we had the preliminary numbers last week. For the month of June, it was a small rise of 0.2%. We do get the quarterly numbers for the June quarter, probably a strong result. So in the June quarter, before the full effect of these rate hikes hit us, we were spending. International trade, we had a record surplus of $16 billion last month, probably down. There's been the floods that have affected some of the mining output and their ability to get it to the export market. So a bit of a dip in the international trade surplus, but it'll still be a surplus of $10 or $12 billion, a really big number.
Enjoy the week, Stephen.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.